Welcome back. This week we're going to change it up a bit. We're going to talk about some fascinating economic trends and how strong really is the consumer. We'll talk about why beef prices are so high, a little bit about inflation, what's coming up with the Chinese-US meeting this weekend, and then we'll get into put sales, where I made another 9.8% return on selling puts. So I'm going to show you how I did that. With that, let's jump in. As always, this is not financial advice. What's going on with the consumer and delinquencies and just how strong the consumer really is. You got the home equities, you got credit cards, auto, student loans, so on and so forth. And you hear people talk about how the credit card delinquencies are going through the roof. Let me go back into history. We'll go back almost 25 years, and this is published by quarter. Every bank has to report what their delinquency is. That's their asset quality. How good are their assets and are they going delinquent? So this is people who are going into the first stage delinquency of 30 days past due. And you hear people talk about how credit cards going up. It is, but it's definitely not as high as it has been in the past. Look at back in 03, 04, 05 timeframe before the great financial crisis, 10% delinquent, 30 days past due. And then it jumped up to as high as 14, 15%. It's not as bad as it has been in the past. But what's interesting is look at student loans. Student loans didn't have delinquency because there were no required payments. That went into effect last year. And look at the delinquency rates. Interesting, right? Overall, not a stark picture as it has been in the past. Now let's take a look at 90 days past due. So this is serious delinquency. Still, same kind of picture. Student loans are way up. Credit cards are up, but not as high as they were in the past. Yes, they are higher than pre-pandemic. That's what everybody talks about, but not as high as it was 15 to 20 years ago. Let's go break it down by age. See who is being affected by this. So look at serious delinquency, 90 days past due by age. And look, your younger consumer is the one that's being hit the hardest. Look at the loans by age for auto, 18 to 29, still being hit the hardest, almost up to 5%. 5% of auto loans are 90 days past due. That's actually not a good number. That's a little bit hard to swallow. That's not a good thing. Take a look at credit cards, 10%. Again, not as high as it was in the past, but still definitely rising. And then this is interesting. Let's look into wage growth. So your year-over-year wage growth by income bracket, think of it as lower income, middle income, and higher income. And the year-over-year growth for that. You can tell that the lower income is only year-over-year growth for wage growth is only 1.4%. That's very low. And then you've got your middle and higher income that above 2%, 2.6 for a higher income. And then Gen X actually has slipped below Gen Z for wage growth. Baby boomers not doing so well. This is down by demographic. And then you've got this one here. So if you take the last 12 months, the difference between the last 3-month average, look at the wage growth, negative 6%. Gen X, a little bit higher and older. So the younger people are not getting as much of a income raise. Look at spending. Where's the spending at? Definitely not in the lower income, as you would expect. Higher income, 2% year-over-year growth, 2.2. And then your middle income, this is where the spending is happening. And then look at the older demographics. A lot of spending in the older demographic. Gen X actually fell below the younger for spending. This is a fascinating chart. Your top 10% of earners account for almost half of the spending out there, whereas your lowest of earners have hardly any effect. There may be more lower income earners, but they don't have that much of effect on spending, whereas the top 10% of earners, there's not as many of those guys out there, but yet they're accounting for a big majority of the spend. Take a look at housing. The housing market, where is it hot and where is it not? Throughout the years, and you may have certain bubbles that are cooling off, like for example, Austin. Looks like Austin, San Antonio here are cooling off. In the past, this was a super hot market. Now you got the East Coast and the West Coast. That's definitely a lot warmer than some of the Midwest, South regions. But this is what I find fascinating. The income needed to purchase a typical home has increased by 79% in 5 years. That's terrible. Have wages increased by 79%? Nope. And this is what's hard on young people. I have kids, they're going to be buying houses in the next few years, and this hurts my head. 80% increase in 5 years, and wages have not increased by that much. Look at the interest rates. This is housing by interest rates. This blue up here is what percentage of homes are above that 6% mark on interest rates. So people are finally like catching up. Hey, rates are going to be higher for longer. Let's go ahead and go out and buy a house. And then you have down here sub 3. 20% of mortgages out here are sub 3. These guys aren't moving. They're not moving. They're not refinancing. These guys will eventually refi. Once rates drop, all of these guys will refi, but you need rates to drop about 1.5% on that long end of the curve. I saw this meme the other day. Yep, no inflation. A pack of ground beef is the same price as it is last month. We will talk about ground beef and why beef is so expensive. But first, let's look at inflation. Just across the board, everything came in actually cooler. We did get inflation on Friday, which was nice, but everything came in lower than expected. This was expected to be 3.1 year over year for headline. Core inflation was expected to be 3.1. It came in lower. Month over month, this was expected to be 0.4 for headline. This is all in, and it came in at 0.3, and then core came in a percentage point lower as well. All right, we're going to orient your eyes to this section here. We're going to look at these two columns. So this is month over month, and this is year over year. Going down the list, food at home. Food is 3.1, but food at home 2.7. Look at this beef, meats, poultry, fish, and eggs. This is definitely the beef component. Cattle prices are through the roof right now. We'll go into that in a minute. And this is what's causing this part of inflation to go up. And then non-alcoholic drinks, so just regular drinks, 5.3%. Don't know what's going on there. Energy, 2.8. This accounts for 6% of inflation. So energy is 2.8, partly driven by an increase in gas. This is, think, natural gas. Cost went up 11% year over year. And then we get down into apparel, had a decline. It's been having a decline. Used cars and trucks, 5.1. So that's an increase there. Tobacco, services. My favorite here, shelter, 3.6%. This is coming down. This is 35% of inflation. This would have been 3.5. This was really 3.567, which caused them to round up to 3.6. But this number is definitely coming down. Rent of primary residence. So think of new rents, 3.4. This will eventually come down to 3, maybe 2.9. This number here, that will definitely be coming down. This has got a long ways to go. This is what people think they can get for rent. So that's at 3.8. This has got almost a percentage point to go. And that will happen over the next several months. And then you've got some other categories here, but these have really small weightings, like 1.8, 1.96 for transportation. And then airline fares, less than 1%, but they went up quite a bit. Let's look at housing. All right, let's break out housing a little bit. So this line here is that 3.8. This 3.8, that is what people think they can get for rent. That number will come down and eventually meet this blue line here. This is the actual rent. Remember, BLS is 12 months behind, actually 11 months behind, and the way they roll it. So this will take time to catch up. We know that rent from Zillow, we can look at their numbers, and they're right around that 3% mark. And sometimes they've actually went down as low as 2.7. So you'll see this number eventually meet it, and this number will meet it as well, and eventually come down. So that's kind of, I like to break this down a little bit. 35% of inflation is this number here, and half that, a lot of that number, 26% of it, is made up of a survey. All right, it's been a minute since we have talked about beef and why beef prices are so high. So this is 1 year ago. Back in December, these are the number of cases that we've reported on screwworm. Remember this line right here? That is the barrier that they were trying to keep it south of this line. And it started creeping north over the last couple of years. And this is why the beef prices have been going up. Slowly but surely, but it wasn't really talked about. Then it started migrating up, and we're starting to get cases up in here. They do have a fly factory right here. Mexico has a very small fly factory that can produce 20 million flies, these sterile flies that can mate with the female flies and prevent it. But as you can see, it hasn't been doing its job. Fast forward to March. Look at all the cases now. We also have a fly factory being built in Texas. This is now in August. Look at all of these cases. Huge increase. This I told you about over the summertime. This is the one 300 miles south of the border. We do have a facility being built. We've got 2 facilities being worked on, about $100 million being spent to produce about 500 million flies a week that will eventually be dropped off in planes and sent down to Mexico. And these flies will then mate with the female fly and they'll eradicate it. That's how they did it back in the 1960s. And they're going to do it again. But they're still several months away from that happening. Now take a look at this. This is the current 70 miles south of Texas. We have had a screwworm case. Now, we had that other case back down here, and it's migrated all the way up to here. Remember, we've closed off the borders for Mexican cattle imports. They have 8,000 fly traps along the border, and they go out and check them every day. So far, so good. They are not seeing these screwworms, flies, in these fly traps, but I guarantee it's only a matter of time. Flies don't care about borders, and they will cross the border. It is coming into winter, but unfortunately, South Texas stays pretty warm and flies can still produce even in midwinter. So I expect this fly to make it to the U.S. and the borders to stay closed for a long time. So they have closed the borders in May. They tried to reopen them in July. They opened them up for a couple of days, and it will stay closed for the foreseeable future. And that is why we're having a huge increase in prices. Take a look at prices. So, $1.85 a pound on average back here. And then look at that. We got all the way up to $2.48 a pound on average. Now, I did have a signal here. I wrote a script that said, hey, this is the good time to sell. I actually shorted it. I did pretty well. Unfortunately, I closed out here and I missed out on Friday's fall. But I'm working on a script here that will mark when it's a good time to sell. And so I took that. But anyways, besides, just a short little plug for something that's coming up in the future. $2.33 a pound. If I was a cattle farmer right now and I didn't need to produce more baby calves, I'd look at selling my cows, honestly. These are some really high prices. And the minute those flies get created, those sterile fly facilities get created, this is going to be a massive short opportunity. I promise. Because we import, get this, 3 billion pounds of beef from Mexico. Right now we're importing nothing. The minute those borders open, you got 3 billion pounds of beef coming to the U.S. I guarantee this will fall. And every contract, every live futures contract is worth $400 per penny. So what I would do, and what I'm doing, is I am buying puts on those contracts. Because if I were to go out and sell that contract, and I have $400 per contract, if it goes up 10 or 15 cents, you're talking $4 to $6 grand out per contract. That gets very expensive. So when I get a signal like this one, I can go out and buy a put contract for a lot less. I can hold the same exposure, but I don't have the risk. So that if I'm wrong and the price shoots up through the roof, then I'm only out what I paid for the put. So that's how I'm going to do it. Part of the reason why this dropped is because Trump said that they were looking at opening up Argentinian beef, but that's not that much. So I think our market may be overreacting. I haven't seen anything in the news about borders reopening. It's going to stay closed for a while, so I would expect this price to go back up. And when it does go back up, maybe it hits that 245, 248, I may do it again. Because Argentinian beef isn't going to have that big of an impact. What will have a huge impact is when they open up Mexico. So definitely keep an eye on that. But that's why beef prices are so high. All right, let's talk about the market. So we had an introduction of volatility in the last couple of weeks. That was nice. That means you can definitely sell some premium back on the market. Remember, a while back there was no premium, and you had to go to other investments, other stocks that had higher premium. Took advantage of that during this period of volatility. But look, rising earnings. So you've got 294.32, 294.81. So this is a positive. You're coming into a seasonal time of the year where the last half of the year, last quarter of the year is positive. You've got some other factors like VIX. You got a decreasing VIX. So here's the volatility when it spiked. You've got decreasing VIX. You've got the VIX 50-day moving average is below the 200-day moving average. Very positive. You have a VIX spike peak signal. That means when VIX spikes and falls 3 points, that's usually a positive. And that happened. So we spiked up to 21 here on this day, and then now we're 16. So we've got a buy signal in place. You had a buy signal in place here because you had a giant spike and then a fall right away. This is a buy signal. VIX term structure. Last week we said that it was in backwardation. Remember, it was higher than the front month, and then it did this number. Now we're in contango, and this is a positive. So you've got an upward sloping VIX forward curve. Very positive. Also, look at the put call ratio. This, keep an eye on that. That may be rolling over. Once that rolls over, that's a positive. Also, look at your new highs and new lows from a market breadth perspective. This is a positive. You had a couple of good days where you were very high. Anything over this red line is considered positive because market breadth is positive. Anything below is negative, and that's what we had beginning to the middle of October. But the market didn't really fall that much. Going back here, you've got a very strong support line right here. That's at about 65-70 mark. So if the market pulls back and hits that, that may be a good time to buy. And then just be careful, because if it falls below that, then that'll be like look out below. But if this support holds, you can bet that will then be very positive if you get a positive bounce off of that. I said a few weeks ago, wouldn't surprise me if we hit 6,800, and we did. We'd hit over 6,800 for the day. Where will we be by the end of the year? Would not surprise me one bit. There's the 7,000 mark. We've only got about 3% to go to hit 7,000. That's crazy. That's crazy. This week, 2.72 on SPX, IWM, 2.4. That closed somewhere around the 249 mark. Remember, I was waiting for it to get back to 235. Every one of these times that it pulled back, I was selling puts at 235, 240, 245. I may have to up my entry price now. What the positive is, I've been collecting premium that whole time. Remember, I said I was going to buy it. I decided to go ahead and sell premium. Well, I'm glad I did, because October was a very good month to sell premium. And I'm up 50% on the portion of my portfolio that I've allocated to IWM. So it's been very good, just waiting for it to get, and I'm not really predicting. Okay, XHB, we tanked a couple weeks ago, 8%. We're starting to come back, closed at around 109. TLT, going to be positive. This is the floor I've been talking about. I am now selling straddles because during the month of October, we moved a lot and we had some wide ranges. I was not straddling TLT. I've started straddling TLT again. I don't expect a whole lot of movement, but I will be very cautious how I straddle TLT, and that's where I'm selling puts and I'm selling calls. So it means I don't expect TLT to go up a whole lot more, and I don't expect it to go down a whole lot less. Said another way, I don't expect interest rates to move 25 basis points up or 25 basis points down. I think it's going to stay within its range. TLT is representative of 20 and 30-year bonds, or 20 and 30-year interest rates. XLU is pretty flat, and then data centers had a good week, and AG&C, one of my favorites, had a very solid week. All right, let's look at what we did this last week in put sales, one of my favorite strategies. But you have to be out of these before earnings. So this is what I did last week. UNH, United Health, I did it on PayPal, Google, Merck, Coinbase, and Amazon. And this is how I got this done. So each one of these, I took a 250 to 500 point spread. Not all of them, but this was like a 200 spread. This is a $250 spread per contract. And for each contract, this is what I made. So $40, $16, $24. And why you think that's not that much? If you have 10 of these or 100 of these, you're only using a small portion of your account. So on this case, if you had 10 of these, at $250, you're taking $2,500 of your portfolio, but you made $240. That's almost 10% return. So I'm just doing these as if though there's just one so that you can see this. This was using $1,400. And if you would add all that up, that's $138 on a $1,400 investment. That is a 9.8% return on that portion of the portfolio. Again, I'm just using one contract to illustrate how this works, but I will enter more contracts as depending on what my conviction is on those particular ones. Sometimes I'll enter a lot more than just one contract, but get an idea, because that in 1 week is not bad so far this week. And these were all 100% successful, by the way. Remember last week we did 14.66. The week before that we did 5.7. This week we did 9.8. And I'm setting it up for next week. Speaking of next week, here's what I'm doing this next week. I will probably enter puts on a lot of these. I'm going to try to get into Palantir, Uber, Arista, Spotify, ARM Holdings, Robinhood, Airbnb, Vistra, and Applied Materials. Those will be the ones that I'm going after. And I will be selling puts down in this range. At this point, this is over the weekend. This is my software is recommending these strike prices, but I will look Monday morning and I will make my determination from there. I will look at the implied volatility. I will multiply it by 1 to 1.5. And depending on my conviction, I will enter a trade between 1 to 1.5 times below implied volatility, which is the expected move. But for the weekend, this is my price. And with premium being so nice right now because volatility is back in the market, yay! It means my ROI, I can get that 10%. So I'll probably get another 10% next week, unless I have something go against me, so I won't be too predictive on that. Every time I say I'm going to do something, the market goes against me. Take a look at this. This is why you don't play this strategy over earnings. There are other strategies you play over earnings, but this particular one you do not play over earnings. You got to be out of it before. And here's a perfect example. Netflix had their worst day in over 3 years. 10% drop on earnings. Okay, so the week before, I was selling puts. I sold a put at the 1150 mark. The week before that, I forget where I was, but I was somewhere in this range as well. And I let these expire on Friday. So I was 100% profitable. I think I made 10%, something like that on Amazon. But I got out before earnings because it tanked. There was an $80 move expected because implied volatility was so high, which is what we play. But again, we're out before earnings. And it not only hit the $80 mark this day, this was the expected move. It's kept on tanking the next few days. Down to 1094. You would have been a negative if you would have tried to play this over earnings. So what I did though is I thought, what are the odds? Again, I'm going to play implied volatility and probabilities. What are the odds that it's going to fall another 10%? So I went way down here and I entered a put. I sold puts at that level. I'd be okay with owning Netflix because that would be a multi-month low. And again, what are the odds? Now, I set that up for a 10% play. So in other words, I sold a put and I bought a put a strike lower or a couple of strikes lower. I risked $500 per contract, but the premium I'm getting is $50 per contract. While it's not much, it's 10% in 1 week. So that's $500 per contract. Again, not bad. Where else are you going to make $50 on 500 or 5,000, whatever you decide to put on that? So that is my play. Take a look at this one, Coinbase. I did have a put this week and it tanked. I entered the put. I looked at the implied volatility Monday morning, said, let's go down 1.5 times implied volatility. Sold my put for a nice, I believe it was $40 premium. Went all the way down. It passed it. Now, this is why I buy that second put. I sell the one and I buy the one below it. That way I protect my downside. Since I'm only risking $250 per contract, it's not that big of a deal. I've got like 20 of these positions open at any one time. I'm only giving you the ones I'm selling these puts on based on the software recommendation, but I have other puts and I have other calls that I'm constantly doing this. So if I have 20, 25 of these at once, and I've got different number of contracts on each one of these, for me to lose $250 per contract on this one, not that big of a deal. Just let it ride. And at this point, I wasn't down $250 because I still had 4 or 5 days left. I think on this one, I was down maybe $100. And if I would have let it wait and it would have closed there, then sure, I'd have been down $250 per contract. But look at the next day. I shot up here and then up another like 6 or 7%. So this expired worthless and I kept the entire premium, making, I want to say it was like $20 or $30 per contract. It's on the previous slide. Anyhow, that was a very nice play. And this is how you play it. Again, diversify like crazy. Do 20 or 30 or 40 or whatever you want on these. You have to diversify. Don't put all your eggs in one basket because as you saw on Netflix, that could happen during the middle of the week and then it could expire. Or Coinbase, what if it would have stayed down? And you put all that portfolio on that part of on that one stock, you'd be toast. So diversify. I do usually about 20 of these a week. All right, so what's coming up? There's only one thing that matters. That is the interest rate decision. Actually, it's not even the decision that matters. It's what they say in the presser. So watch that on Wednesday. We are expecting a rate cut. In fact, we're expecting a 98.3% chance of a rate cut. That's what the market's priced in. There's going to be a rate cut. There's no reason. You've got unemployment that's falling. You've got inflation. What inflation? There's not really much inflation except in beef prices. Housing we know is coming down. So yeah, it's time to drop rates. So we've got 2 cuts priced in by the end of the year. You got one this coming week, and then you got one in December. And then you got next year, 3 cuts. I think that's a little bit light. Especially in this range here. Because I think you're going to get somebody like Jerome Powell's leaving in May. When he leaves in May, Trump's going to put somebody in that will be a Trump fan and will be aligned with him as far as rate cuts. We know we've already got 4 dissenters on the board of governors. You know that he's going to put somebody in there, and then rates will fall. So I think that's going to definitely be more than this. This puts us at about the 2.75 to 3% range. I would expect it to be probably more in this range by the end of next year. So 2 or 3 cuts more than what's currently implied. Now, again, this is just for the front end of the curve. This is not mortgage rates. Mortgage rates are based on the 10-year. This is just the overnight rate. Now, the 10-year will fall, but not as much. Again, I don't think mortgage rates are going to go any higher than they are today, but I don't think they're going to go a whole lot lower unless there's a recession. Finally, the last update for you, tariffs. So we got a big meeting going on this week. I'd be remiss if I didn't tell you about it. You've got Treasury Secretary Scott Bessent and Jameson Greer meeting with the Chinese Vice Premier in Malaysia. They're meeting as we speak, Saturday and Sunday, and they're going to come out with what their demands are. They're not going to probably come out with a whole lot. But Trump is wanting to focus on rare earth, soybeans, and fentanyl. Rare earths, or let's go with soybeans first. He wants China to buy more soybeans. China has stopped buying soybeans from us. He wants the rare earths. And then what does Chinese want? Chinese is wanting just fair negotiations. They want a solid framework, and they want reduction. Remember that 100% tariff that they slapped on, the U.S. slapped on them? They want that reduced. So why do rare earths matter? Think clean energy, anything to do with EVs, turbines, clean energy, anything to do with that. Green. China has 44 million tons of this in the ground. They produce 80% of the world's capacity of rare earths. We have 1.6 million, so we have nothing. We can't keep up with the current demands, so we need the rare earths. And this is their negotiating tactic, is to hold that. Now, these are the rare earth elements that we are interested in. So we'll see what happens out of this meeting. I don't expect much. The main objective is to come out with a framework and then to set it up for a successful meeting for Trump and Xi next week. But expectations for a final deal should be low. However, I took a stab at what would happen if we had some outcomes. Let's take a look. So if we have positive progress and officials come out with a joint statement saying that, hey, we've got a clear path forward on tariffs, you can expect the market to rally. This will be very positive, gains across all sectors. If you have a negative breakdown and you're like, watch Truth Social, because if Trump says, they didn't meet, something broke down, and you can expect the market to fall. If that happens, actually watch Bitcoin over the weekend or any of the cryptos, because that's a risk on, risk off appetite, and that'll give you some kind of sentiment. If one of those are tanking over the weekend because of something that came out on Truth Social, then you can expect the market to open up negative. I would expect this, put a percentage of about 25% on the negative breakdown, put a percentage of 25% on the positive, that they come out with something. I don't expect them to come out with anything. What I do expect is this neutral. Put a 50% probability of that happening, and that is nothing happens. They kick the can down the road. They say that they're going to continue the dialogue, and no real decision is made. That's what's happened in the past. Oh, let's just pause the tariffs another 6 months. Let's pause them another 3 months, whatever. So that's probably what will happen in something like this. Maybe they'll come out with something, but then the market's going to be like, probably be mixed to sideways. So those are my predictions. With that, thank you again. Hope you enjoyed this video. Please let me know in the comments if you guys have any questions, you want me to cover any topic, company, whatever. Let me know in the comments, and I'll be glad to share it with you. By the way, if anybody out there is still listening, and you guys have TradingView, let me know. I've got a script that I have written that I need a couple of testers on. I'll give it to you for free. Just let me know. Drop me a note in the comment or send me an email. Thanks again. Have a great trading week up ahead. Have a good one.